In a bustling city, there lived a man named Alex. Alex was in his late 30s, a seasoned investor who had seen his fair share of ups and downs in the financial markets. He was intrigued by the concept of reflexivity, as outlined by the famous investor George Soros. One day, while reading Soros's book, The Alchemy of Finance, Alex came across the concept of feedback loops in the markets. He remembered a time when he had witnessed this phenomenon firsthand. Several years ago, there was a booming real estate market in the city. Prices were soaring, and everyone seemed to be investing in property. Alex, too, was caught up in the excitement and decided to buy a condo as an investment. As more people bought properties, the prices continued to rise. This created a feedback loop, where rising prices fueled more buying, leading to even higher prices. However, Alex remembered Soros's warning about the dangers of market bubbles. Despite the temptation to buy more properties and ride the wave, Alex decided to sell his condo and lock in his profits. Shortly after, the real estate market crashed, leaving many investors in financial ruin. Reflecting on this experience, Alex realized the importance of being aware of market dynamics and not getting carried away by the herd mentality. He also understood the value of managing risk and being prepared to act swiftly when market conditions changed. Armed with these insights, Alex continued to navigate the financial markets with a cautious yet opportunistic approach. He understood that while markets could be unpredictable, having a solid understanding of market psychology and being adaptable were key to long-term success. And so, Alex's journey in the world of finance continued, filled with valuable lessons learned from the teachings of George Soros from the book The Alchemy of Finance. Now let's take a look at each of those valuable points from this book, one by one. Number 15. Reflexivity. Reflexivity, as introduced by investor and philanthropist George Soros, is a concept that challenges the traditional notion of market efficiency. While conventional economic theory often assumes that markets tend towards efficiency, Soros argues that this is not always the case. According to him, markets can be influenced by the perceptions and biases of the participants, leading to feedback loops that can affect market prices and fundamentals. At the core of Soros' concept of reflexivity is the idea that market participants' perceptions are not always based on an objective assessment of reality. Instead, their perceptions can be influenced by a variety of factors, including psychological biases, cognitive limitations, and social influences. These perceptions, in turn, can influence their behavior in the market, leading to actions that can affect market prices and conditions. One key aspect of reflexivity is the idea of feedback loops. According to Soros, these feedback loops can operate in two directions, positive and negative. A positive feedback loop occurs when a participant's perception of market conditions leads them to take actions that reinforce those conditions. For example, if investors believe that a stock is undervalued, they may buy more of it, driving up the price and reinforcing their belief. This can create a self-reinforcing cycle that pushes prices further away from their fundamental value. Conversely, a negative feedback loop occurs when a participant's perception of market conditions leads them to take actions that counteract those conditions. For example, if investors believe that a stock is overvalued, they may sell it, driving down the price and reinforcing their belief. This can create a self-reinforcing cycle in the opposite direction, pushing prices closer to their fundamental value. Soros argues that these feedback loops can lead to the formation of bubbles and crashes in financial markets. A bubble occurs when positive feedback loops drive prices far above their fundamental value, while a crash occurs when negative feedback loops drive prices far below their fundamental value. In both cases, the market deviates from its efficient state, leading to potential misallocations of resources and economic instability. To illustrate the concept of reflexivity, let's consider the example of a housing bubble. In the early 2000s, many housing markets around the world experienced a significant increase in prices, fueled by a combination of low interest rates, lax lending standards, and speculative buying. As prices rose, many investors and homebuyers began to believe that housing prices would continue to increase indefinitely, leading them to buy more homes and bid up prices even further. This created a positive feedback loop that drove prices to unsustainable levels. However, as housing prices reached unsustainable levels, cracks began to appear in the market. Some investors started to realize that prices were out of line with fundamentals and began selling their properties, leading to a negative feedback loop that drove prices down. This, in turn, led to further selling and a collapse in prices, ultimately resulting in the housing market crash of 2007 to 2008. Another example of reflexivity can be seen in the stock market. When investors believe that a particular stock is undervalued, they may buy more of it, driving up the price. This can reinforce the perception that the stock is undervalued, leading to further buying and price appreciation. However, if the initial perception was incorrect and the stock was actually overvalued, this positive feedback loop can eventually lead to a correction as the market re-evaluates the stock's true value. Number 14. Theory of Fallibility. George Soros's theory of fallibility is a key component of his broader framework of reflexivity in financial markets. According to this theory, our understanding of the world is inherently imperfect and subject to error. This means that our perceptions, beliefs, and theories about how the world works are always flawed to some degree, and we can never have complete and perfect knowledge. Soros contrasts his theory of fallibility with the concept of perfect knowledge, which is often assumed in traditional economic theory. In the classical economic view, individuals are assumed to have access to all relevant information and to make rational decisions based on this information. This assumption underpins the concept of market efficiency, which suggests that asset prices reflect all available information and are therefore always correct. However, Soros argues that this assumption of perfect knowledge is unrealistic and fails to capture the complexities of real-world decision-making. He suggests that our understanding of the world is always partial and incomplete, and that our perceptions and beliefs are shaped by a variety of factors, including our experiences, emotions, and social influences. One implication of the theory of fallibility is that our beliefs about the world can influence the world itself. This idea is central to Soros's concept of reflexivity, which suggests that there is a two-way feedback loop between our beliefs and the external reality they are supposed to represent. According to Soros, our beliefs can affect the decisions we make, which in turn can affect the outcomes in the world, leading to feedback loops that can amplify or distort market trends. For example, if investors believe that a particular asset is undervalued, they may buy more of it, driving up its price. This can reinforce the belief that the asset is undervalued, leading to further buying and price appreciation. However, if the initial belief was incorrect and the asset was actually overvalued, this positive feedback loop can eventually lead to a correction as the market re-evaluates the asset's true value. The theory of fallibility also has important implications for how we approach decision-making in complex and uncertain environments. Soros argues that because our understanding of the world is imperfect, we should approach decision-making with humility and openness to new information. He emphasizes the importance of reflexivity in decision-making, which involves constantly reflecting on and revising our beliefs in light of new evidence and changing circumstances. George Soros's theory of fallibility challenges the assumption of perfect knowledge in traditional economic theory. According to Soros, our understanding of the world is always imperfect and subject to error, leading to unpredictable outcomes in markets. By recognizing the limitations of our knowledge and embracing reflexivity in decision-making, we can gain a deeper understanding of the complexities of the world and potentially improve our ability to navigate uncertain environments. Number 13. Market participants. George Soros emphasizes the role of market participants' biases, misconceptions, and actions in shaping market trends and outcomes. According to Soros, market participants do not always act rationally or in accordance with fundamental economic principles. Instead, their behavior is often influenced by psychological factors, such as emotions, cognitive biases, and social influences. These factors can lead to the formation of bubbles and crashes in financial markets, as well as other patterns that deviate from the efficient market hypothesis. One key concept in Soros's framework is the idea of reflexivity, which suggests that there is a two-way feedback loop between market participants' perceptions and the external reality they are supposed to represent. According to Soros, market participants' perceptions are not always based on an objective assessment of reality. Instead, their perceptions can be influenced by a variety of factors, including their own biases and the behavior of other market participants. For example, if investors believe that a particular stock is undervalued, they may buy more of it, driving up its price. This can reinforce the belief that the stock is undervalued, leading to further buying and price appreciation. However, if the initial belief was incorrect and the stock was actually overvalued, this positive feedback loop can eventually lead to a correction as the market reevaluates the stock's true value. Similarly, if investors believe that a particular asset is overvalued, they may sell it, driving down its price. This can reinforce the belief that the asset is overvalued, leading to further selling and price depreciation. Again, if the initial belief was incorrect and the asset was actually undervalued, this negative feedback loop can eventually lead to a correction as the market reevaluates the asset's true value. Soros also emphasizes the role of misconceptions in shaping market trends. He argues that market participants' perceptions are often based on misconceptions or false assumptions about how the world works. These misconceptions can lead to patterns of behavior that deviate from rationality and can result in market inefficiencies. For example, during the dot-com bubble of the late 1990s, many investors believed that internet companies were a new paradigm that would change the world, leading to inflated stock prices. However, when the bubble burst in the early 2000s, it became clear that many of these companies were overvalued and that the market had been driven by misconceptions about their true value. George Soros emphasizes the role of market participants' biases, misconceptions, and actions in shaping market trends and outcomes. According to Soros, market participants do not always act rationally or in accordance with fundamental economic principles, and their behavior can be influenced by psychological factors. By recognizing the role of reflexivity and misconceptions in markets, investors can gain insights into market dynamics and potentially identify investment opportunities and risks. Number 12. Feedback loops. George Soros's concept of reflexivity is closely tied to the idea of feedback loops in financial markets. According to Soros, feedback loops can amplify market trends, leading to booms and busts that are not necessarily based on fundamental value. These feedback loops are driven by the interactions between market participants' perceptions, beliefs, and actions, which can create self-reinforcing cycles that push prices away from their intrinsic value. One type of feedback loop that Soros identifies is a positive feedback loop, which occurs when a change in market prices leads to further changes in the same direction. For example, if investors believe that a particular stock is undervalued and start buying it, the increase in demand can drive up the stock's price. This price increase can reinforce the belief that the stock is undervalued, leading to further buying and price appreciation. This positive feedback loop can continue until the stock's price reaches a level that is no longer supported by its fundamentals, at which point it may experience a sharp correction. Another type of feedback loop is a negative feedback loop, which occurs when a change in market prices leads to changes in the opposite direction. For example, if investors believe that a particular asset is overvalued and start selling it, the increase in supply can drive down the asset's price. This price decrease can reinforce the belief that the asset is overvalued, leading to further selling and price depreciation. This negative feedback loop can continue until the asset's price reaches a level that is more in line with its fundamentals. Feedback loops can also occur at a macroeconomic level, affecting entire economies or financial markets. For example, during an economic boom, rising asset prices can lead to increased consumer spending and investment, which can further stimulate economic growth and asset price appreciation. This positive feedback loop can create a self-reinforcing cycle of economic expansion. Conversely, during an economic downturn, falling asset prices can lead to reduced consumer spending and investment, which can further depress economic activity and asset prices. This negative feedback loop can create a self-reinforcing cycle of economic contraction. Soros argues that these feedback loops can lead to the formation of bubbles and crashes in financial markets. A bubble occurs when positive feedback loops drive prices far above their fundamental value, while a crash occurs when negative feedback loops drive prices far below their fundamental value. In both cases, the market deviates from its efficient state, leading to potential misallocations of resources and economic instability. George Soros discusses how feedback loops can amplify market trends, leading to booms and busts that are not necessarily based on fundamental value. These feedback loops are driven by the interactions between market participants' perceptions, beliefs, and actions, and can create self-reinforcing cycles that push prices away from their intrinsic value. By understanding the role of feedback loops in markets, investors can gain insights into market dynamics and potentially identify investment opportunities and risks. Number 11. Historical perspectives. George Soros emphasizes the importance of historical perspectives in understanding financial markets and predicting market movements. According to Soros, historical events can have a significant impact on market dynamics, shaping investors' perceptions, beliefs, and behaviors. By studying history, investors can gain insights into how markets have responded to similar events in the past and use this knowledge to make more informed decisions about future market movements. One key aspect of Soros's approach is the recognition that history does not repeat itself exactly, but it often rhymes. This means that while each historical event is unique, there are often similarities and patterns that can be identified and used to understand how markets may behave in similar situations. By studying these patterns, investors can develop a more nuanced understanding of market dynamics and better anticipate potential market movements. For example, Soros has written extensively about the impact of financial crises on market behavior. He has argued that financial crises tend to follow a similar pattern, characterized by a period of rapid credit expansion, followed by a sudden contraction as investors become more risk-averse. By studying past financial crises, investors can gain insights into how markets have responded to similar events in the past and use this knowledge to prepare for future crises. Soros also emphasizes the role of reflexivity in shaping historical events and market movements. According to Soros, market participants' perceptions and beliefs can influence the course of events, creating feedback loops that can amplify or distort market trends. By understanding these feedback loops, investors can gain insights into how markets may respond to different stimuli and events. One example of the importance of historical perspectives in predicting market movements is the study of market cycles. By studying past market cycles, investors can gain insights into the typical patterns of market behavior, including the timing and duration of bull and bear markets. This can help investors anticipate when markets may be due for a reversal and adjust their investment strategies accordingly. George Soros emphasizes the importance of historical perspectives in understanding financial markets and predicting market movements. By studying historical events and patterns, investors can gain insights into how markets have responded to similar situations in the past and use this knowledge to make more informed decisions about future market movements. Number 10. Investor psychology. Understanding investor psychology is crucial in analyzing financial markets. Emotions such as fear and greed play a significant role in driving market behavior, often leading to irrational decision-making and herd mentality. George Soros's insights into investor psychology are particularly enlightening in this regard. Fear is a powerful emotion that can lead investors to panic sell during market downturns, exacerbating price declines. This behavior is driven by a desire to avoid further losses and can create a self-reinforcing cycle of selling and declining prices. Soros often emphasizes the importance of overcoming fear in investing, as it can cloud judgment and lead to poor decision-making. Greed, on the other hand, can drive investors to take excessive risks in pursuit of high returns. This behavior can lead to asset bubbles, where prices become disconnected from their underlying fundamentals. Soros warns against succumbing to greed in investing, as it can lead to unsustainable market trends and eventual corrections. Herd mentality is another psychological phenomenon that Soros discusses in relation to investor behavior. When investors see others buying or selling a particular asset, they may feel compelled to follow suit, regardless of the underlying fundamentals. This herd behavior can lead to market inefficiencies and contribute to the formation of bubbles and crashes. Soros also discusses the concept of reflexivity in relation to investor psychology. According to Soros, investors' perceptions and beliefs can influence market prices, creating feedback loops that can amplify market trends. This reflexivity can lead to market bubbles and crashes, as prices become disconnected from their underlying fundamentals. Overall, Soros's insights into investor psychology highlight the importance of understanding the role of emotions and herd mentality in driving market behavior. By recognizing these psychological factors, investors can make more informed decisions and avoid falling prey to irrational behavior. Number 9. Risk management. Risk management is a critical aspect of investment decision-making, and George Soros emphasizes its importance in his approach to investing. Soros believes that managing risk is essential for long-term success in the markets, and he employs several key strategies to mitigate risk in his own investments. One of the key risk management strategies Soros advocates is the use of stop-loss orders. A stop-loss order is an order placed with a broker to buy or sell a security once the price reaches a certain level. By using stop-loss orders, investors can limit their potential losses and protect their capital in case the market moves against them. Soros often emphasizes the importance of setting stop-loss levels based on sound analysis and sticking to them, even in the face of short-term market fluctuations. Position sizing is another important aspect of risk management that Soros focuses on. Position sizing refers to the amount of capital allocated to a particular investment relative to the total capital available. Soros believes in the importance of diversification and recommends allocating only a small percentage of total capital to any single investment. This helps to reduce the impact of any one investment on the overall portfolio and limits the potential downside risk. Soros also emphasizes the importance of staying flexible and adaptive in response to changing market conditions. He believes that markets are inherently unpredictable, and investors should be prepared to adjust their strategies in response to new information. This includes being willing to cut losses quickly if a trade is not working out as planned, as well as being open to taking profits when opportunities arise. Overall, Soros's approach to risk management is grounded in the belief that preserving capital is paramount in investing. By using stop-loss orders, practicing prudent position sizing, and staying flexible in response to market conditions, investors can reduce their risk exposure and increase their chances of long-term success in the markets. Number 8. Market timing. George Soros is known for his view that market timing is extremely difficult, if not impossible, to consistently achieve. He emphasizes the importance of being flexible and adaptive in response to changing market conditions, rather than trying to predict the timing of market movements. One reason Soros believes that market timing is so challenging is the presence of reflexivity in financial markets. Reflexivity refers to the idea that market participants' perceptions and actions can influence market fundamentals, creating feedback loops that can amplify or distort market trends. This means that trying to time the market based on past trends or patterns may be futile, as these trends can change rapidly in response to new information and investor behavior. Soros also points out that markets are influenced by a wide range of factors, including economic indicators, geopolitical events, and investor sentiment, among others. These factors are often unpredictable and can lead to sudden and unexpected market movements. Soros argues that it is therefore more important to focus on understanding the underlying fundamentals of the assets in which one is investing, rather than trying to time short-term market movements. Instead of trying to time the market, Soros advocates for a strategy of reflexivity in reverse. This involves constantly reassessing one's assumptions and beliefs about the market and being willing to change course if new information suggests that one's initial thesis was incorrect. By staying flexible and adaptive, investors can position themselves to take advantage of opportunities as they arise, while also protecting themselves from potential losses. George Soros emphasizes the difficulty of timing markets and the importance of being flexible and adaptive in response to changing market conditions. Rather than trying to predict short-term market movements, Soros advocates for a focus on understanding the underlying fundamentals of the assets in which one is investing and being prepared to adjust one's strategy as new information becomes available. Number 7. Political and economic factors. George Soros considers political and economic factors to be crucial in shaping financial markets. He believes that government policies, international relations, and other geopolitical factors can have a significant impact on market dynamics, often leading to both risks and opportunities for investors. One key concept that Soros emphasizes is the concept of reflexivity in the relationship between markets and politics. According to Soros, market participants' perceptions and actions can influence political and economic realities, creating a feedback loop that can amplify or distort market trends. For example, if investors believe that a government's economic policies are unsustainable, they may sell off the country's currency, leading to a depreciation that can in turn make the policies even more unsustainable. Soros also recognizes the role of government policies in shaping market outcomes. He believes that government interventions, such as monetary policy decisions and regulatory changes, can have a significant impact on market behavior. For example, changes in interest rates by central banks can affect borrowing costs and investment decisions, while regulatory changes can impact the profitability and operations of businesses in various industries. In addition, Soros considers international relations to be an important factor in financial markets. Geopolitical events, such as conflicts, trade disputes, and diplomatic tensions, can create uncertainty and volatility in the markets. Soros believes that investors need to be aware of these factors and their potential impact on market dynamics. Soros's approach to investing emphasizes the importance of understanding the interplay between political and economic factors and financial markets. By recognizing the influence of these factors on market behavior, investors can better anticipate risks and opportunities and adjust their investment strategies accordingly. Number 6. Open society. George Soros is a strong advocate for the concept of an open society, which he defines as a society that is based on principles such as freedom, democracy, and respect for individual rights. According to Soros, an open society is characterized by a government that is accountable to its citizens, a free press, and a vibrant civil society. Soros believes that open societies are more prosperous, just, and stable than closed societies, which are characterized by authoritarian rule, lack of political freedoms, and restrictions on individual rights. One of the key principles of an open society, according to Soros, is the recognition that no one has a monopoly on the truth. He believes that in an open society, people should be free to express their opinions, engage in debate, and challenge established beliefs and institutions. This diversity of perspectives, Soros argues, leads to a more dynamic and innovative society. Soros also emphasizes the importance of democracy in an open society. He believes that democracy is the best way to ensure that governments are accountable to their citizens and that individual rights are protected. Soros has been a strong supporter of democratic movements around the world, providing financial support to civil society organizations that promote democracy and human rights. In addition to democracy, Soros believes that an open society should also be characterized by respect for individual rights. He argues that all individuals should have the right to freedom of expression, freedom of association, and freedom of religion, among other rights. Soros has been a vocal critic of governments and organizations that violate these rights, and has used his philanthropic efforts to support groups that work to protect them. Soros's advocacy for the concept of an open society reflects his belief in the importance of freedom, democracy, and individual rights. He believes that by promoting these values, societies can become more just, prosperous, and inclusive for all their citizens. Number 5. Globalization. George Soros has been a prominent voice in discussing the impact of globalization on financial markets. He highlights the interconnectedness of economies around the world and the need for global cooperation to address the challenges and opportunities that globalization brings. One of the key aspects of globalization that Soros emphasizes is the increased interdependence of economies. He points out that events in one part of the world can have ripple effects that are felt in other parts of the world. For example, a financial crisis in one country can quickly spread to other countries through interconnected financial markets, leading to a global economic downturn. Soros also discusses the role of technology in driving globalization. Advances in technology, such as the Internet and telecommunications, have made it easier for goods, services, and information to flow across borders. This has led to increased trade and investment flows, as well as greater integration of global financial markets. However, Soros also highlights some of the challenges posed by globalization. He points out that globalization can lead to increased income inequality, as the benefits of globalization are not always distributed evenly. He also warns that globalization can lead to a loss of national sovereignty, as countries become more dependent on global markets and institutions. Despite these challenges, Soros believes that globalization has the potential to bring about positive change. He argues that by promoting global cooperation and understanding, globalization can help to address global challenges such as poverty, disease, and climate change. He also believes that globalization can promote economic growth and development, particularly in developing countries. Soros's discussion of globalization emphasizes the need for global cooperation and understanding in addressing the challenges and opportunities that globalization brings. He believes that by working together, countries can harness the benefits of globalization while mitigating its negative impacts. Number 4. Speculation versus investment. George Soros distinguishes between speculation and investment, highlighting the different approaches and objectives of each. According to Soros, speculation involves making bets on short-term market movements, often based on technical analysis or market trends. Speculators are primarily interested in profiting from short-term price fluctuations, and their actions can contribute to market volatility. In contrast, Soros defines investment as a long-term commitment to a particular asset based on its underlying value. Investors conduct thorough research and analysis to determine the intrinsic value of an asset, and they are willing to hold on to the asset for an extended period, even if its price fluctuates in the short term. Investors are focused on the long-term growth and income potential of the asset, rather than short-term market movements. Soros believes that speculation can be risky and unpredictable, as it is often driven by factors such as market sentiment and investor psychology. Speculators may also use leverage to amplify their returns, which can increase the risk of significant losses. In contrast, Soros views investment as a more stable and sustainable approach to wealth creation, as it is based on a thorough understanding of the underlying fundamentals of the asset. However, Soros acknowledges that there is a fine line between speculation and investment, and that successful investors often incorporate elements of both approaches into their strategies. He believes that investors should be flexible and adaptive, willing to adjust their strategies in response to changing market conditions. By combining elements of speculation and investment, Soros believes that investors can achieve long-term success in the markets while managing risk effectively. Number 3. Market bubbles. George Soros is well known for his warnings about the dangers of market bubbles. He believes that market bubbles are driven by speculative excess, where investors bid up the prices of assets to unsustainable levels. This can happen when investors become overly optimistic about the future prospects of an asset or market, leading them to ignore underlying fundamentals. One key characteristic of market bubbles, according to Soros, is the presence of a feedback loop between market prices and investor behavior. As prices rise, investors may become more optimistic and buy more of the asset, further driving up prices. This can create a self-reinforcing cycle of buying and rising prices, which can push asset prices far above their intrinsic value. However, Soros warns that market bubbles are inherently unstable and are prone to sharp corrections. When the bubble eventually bursts, prices can fall rapidly as investors rush to sell their holdings. This can lead to significant losses for investors who bought into the bubble at inflated prices. Soros believes that market bubbles are difficult to predict, as they are driven by a combination of factors, including investor psychology, market dynamics, and external events. However, he argues that investors can reduce their risk exposure to bubbles by practicing prudent risk management and avoiding speculative excess. One strategy Soros recommends is to use stop-loss orders to limit potential losses in case a bubble bursts. By setting stop-loss levels based on sound analysis and sticking to them, investors can protect themselves from the worst effects of a market downturn. Soros also advises investors to diversify their portfolios and avoid putting all their eggs in one basket, as this can help to mitigate the impact of a bubble bursting in any one asset or market. Overall, Soros's warnings about market bubbles serve as a reminder of the importance of caution and risk management in investing. While it may be tempting to chase high returns during a bubble, Soros cautions that the risks of doing so are often not worth the potential rewards. Number 2. Reflexivity in action. George Soros often uses his own experiences in the financial markets to illustrate the concept of reflexivity in action. One of the most famous examples of this is his role in the 1992 Black Wednesday currency crisis, where Soros famously broke the Bank of England by betting against the British pound. In the early 1990s, the British government was part of the European Exchange Rate Mechanism, ERM, which required the pound to be pegged to other European currencies within a narrow range. However, Soros believed that the pound was overvalued and that the British government would not be able to maintain the peg. He began building a large short position against the pound, betting that it would eventually be devalued. Soros's actions had a profound impact on the currency markets. As more investors followed his lead and began selling the pound, its value started to decline. This created a self-reinforcing cycle of selling, as the falling value of the pound validated Soros's initial belief that it was overvalued. Eventually, the British government was forced to abandon the ERM and devalue the pound, resulting in significant losses for those who had bet against it. Another example of reflexivity in action is Soros's theory of the virtuous and vicious cycles in financial markets. According to Soros, markets are characterized by feedback loops that can create self-reinforcing trends. In a virtuous cycle, positive feedback loops drive asset prices higher, leading to further buying and price appreciation. In a vicious cycle, negative feedback loops drive prices lower, leading to further selling and price depreciation. Soros has used this theory to explain various market phenomena, such as the formation of bubbles and crashes. For example, in the dot-com bubble of the late 1990s, positive feedback loops drove up the prices of internet stocks, leading to a self-reinforcing cycle of buying and price appreciation. Similarly, in the housing bubble of the mid-2000s, positive feedback loops drove up home prices, leading to a self-reinforcing cycle of buying and price appreciation. Soros's experiences in the financial markets provide compelling examples of reflexivity in action. By understanding how market participants' perceptions and actions can influence market trends, investors can gain insights into the dynamics of financial markets and potentially identify investment opportunities and risks. Number 1. Practical insights. George Soros has shared a wealth of practical insights and strategies for navigating the complexities of financial markets, drawing from his own experiences and observations. One of the key principles he emphasizes is the concept of reflexivity, which suggests that market participants' perceptions and actions can influence market trends. Soros believes that understanding this concept is crucial for successful investing, as it can provide insights into market dynamics and help identify investment opportunities and risks. Soros also advocates for a reflexive approach to decision-making, where investors constantly reassess their assumptions and beliefs in light of new information. By being willing to change course if new evidence suggests that their initial thesis was incorrect, investors can adapt to changing market conditions and improve their investment outcomes. Managing risk is another key aspect of Soros's approach to investing. He recommends using stop-loss orders to limit potential losses, diversifying your portfolio to reduce risk, and staying flexible and adaptive in response to changing market conditions. By incorporating these risk management strategies into your investment approach, you can protect yourself from the worst effects of market downturns and improve your chances of long-term success. Soros's insights into investor psychology are also valuable for navigating financial markets. He emphasizes the role of emotions such as fear and greed in driving market behavior, and warns against succumbing to these emotions in investing. By staying disciplined and rational in your decision-making, you can avoid making impulsive decisions that may lead to losses. Overall, Soros's practical insights and strategies for navigating financial markets reflect his deep understanding of market dynamics and his belief in the importance of flexibility, risk management, and reflexivity in investing. By incorporating these principles into your own approach, you can potentially improve your investment outcomes and better navigate the complexities of financial markets.